Thank you for joining our second quarter market outlook. My name is TJ Kistner. I'm the Chief Investment Officer at Retirement Plan Advisors. Welcome to our first edition in our new quarterly webinar series, where we will review market performance and discuss our forward-looking views across asset classes. We hope you find the information helpful and informative. The second quarter was quite strong for markets, particularly U.S. equities and risk assets. U.S. stocks were up 8.4% in the quarter, which outpaced non-U.S. stocks by over 5% and emerging markets by over 7%. Bonds were negative during the quarter as interest rates moved higher due to sticky inflation and concerns the Fed would need to do more to slow down the labor market and the economy. On a year-to-date basis, U.S. stocks are up over 16%, with other developed countries outside the U.S. up over 11%. And there was some initial optimism around the reopening of China's economy from COVID restrictions, but unfortunately growth has stalled there and dragged down performance of emerging markets. Zooming in on the U.S. equity market, as we look at returns across style and size, it's pretty clear that large cap growth stocks are driving performance so far this year. This is a reversal of what happened in 2022 and generally in line with what we saw over the preceding decade leading into last year. High-quality tech companies not only have extremely strong balance sheets, they are also best positioned to capitalize on the promising growth opportunities associated with artificial intelligence, or AI. In fact, if we look at the year-to-date performance of the S&P 500 through June, around 75% of the index's return is attributed to just 7 stocks: Apple, Microsoft, Nvidia, Amazon, Meta, Tesla, and Google. These stocks account for 12.5% of the index's 16.9% return, meaning the S&P 493 has only returned 4.4% year-to-date, much of which came toward the end of the quarter. This narrow market leadership was discussed quite a bit during the quarter, but in the final few weeks, we started to see the bull market expand beyond these 7 names, which is a good sign for further upside. As we think about the macro environment moving forward, we still have some concerns that lead us to be neutral to slightly defensive in our portfolios. Inflation, though it is coming down, is still relatively high at 4 to 5%, and the unemployment rate is at multi-decade lows, and we recently saw continued strength in ADP numbers last week. This is likely to keep pressure on wage inflation and allow consumers to continue to spend throughout the economy and keep prices elevated. As we think about real interest rates, they remain in negative territory, which is not restrictive from a monetary policy standpoint. So for these reasons, we do think the Fed is likely to hike interest rates another 1 to 2 times this year. We also continue to see several recessionary signals flashing throughout the macro data. The yield curve has been inverted for about a year now, and the level of inversion has rarely been seen in recent history. Credit activity has stalled and is declining, delinquencies are rising, there's stress in certain areas of the commercial real estate market, particularly in office buildings, as vacancy rates remain elevated. And in addition, a large amount of debt in this space is coming due in the next year, at a time when prevailing interest rates are much higher, which will constrain the ability to refinance those properties. And arguably most importantly, we're starting to see unemployment claims rise, albeit very slowly and from very low levels. But if this trend continues, we could start to see the economy slow down materially. Switching to our global asset class views, as I mentioned just a moment ago, we remain neutral to slightly cautious in areas such as equities and credit, as there remain a number of macroeconomic uncertainties and the Federal Reserve continues to promote a hawkish stance. However, it's hard to be overly bearish in stocks and bonds, as the overall economy has been strong and resilient. Corporate fundamentals look strong, and we still have a very strong labor market. We do think interest rates have risen to the point where treasuries and cash can offer attractive return profiles. With the 10-year treasury around 4%, not only are yields more attractive than at any time over the last 10 to 15 years, but if or when the Fed ultimately begins to cut interest rates, this can create a very attractive total return opportunity for treasuries. Remember, bond prices are inversely related to interest rates, so as interest rates go down, bond prices go up. Similarly, while we prefer to remain almost fully invested at all times, certain cash and money market investments are offering north of 4% yields in the current environment, which can reduce the opportunity cost of not being invested in risk assets. Drilling one step further into the equity and fixed income markets, we remain neutral across the equity spectrum with a preference for quality companies and businesses, particularly in the U.S. Now, there are certain attractive areas outside the U.S. in countries like Japan and India, but other regions like the UK and China have significant and persistent economic headwinds that warrant caution. Within fixed income, we also have a preference for higher quality credits, and we are wary of areas of the market that are below investment grade, such as high yield bonds and bank loans, as the spread they offer above treasuries is relatively tight, and prices for those issues could react poorly to a downturn in the economy. Thank you for listening. We hope you found the information helpful. And remember, the future is better than you think.